Yeah, we'll just start with that. The reason the markets are horrible is, first off, it's December, so December sometimes is lower volume. You get thinner liquidity, but usually thinner liquidity means you get less decisive moves in the market, and you get whipsaws that kind of happen, right? When you're in a market that's thinner liquidity, large orders, for example, are gonna move the market significantly, right? So you're not getting that accuracy that you'll normally get in a very liquid market. However, I don't think we're there yet. That's maybe in the later half of December, beginning of January, right? I think that the reason markets suck right now is we're at a monthly close, right? So just like power 3 for the daily, the monthly also is power 3, right? So we formed the buy side wick of the last monthly candle, or sorry, of this monthly candle right here. Wait, what the hell? It's the first, yeah. So last monthly candle right here. So we spent some time in this range, formed that topside wick, that last candle. Just looking at the monthly candle, looks like we'll go up. Okay. Now, what we would do likely is form, if we are to go up, I'm not going to say that we are or we aren't, but if we are, we're going to form that sell side wick, right? So we're going to be stuck in that range now from the high of the previous candles to the low of the new candle, if we are to go up. Of course, I mean, this can sweep up here and then we could drop a little bit. We don't know, but we are stuck in a range, right? So what that is doing, power of 3, is building out the range from the start of the previous month. So this is November. We're now in December. So we're going to continue that range. Look for a manipulation. We don't know when that's really going to happen. I would love to get like average numbers of when the low or the high of the month is in. That'd be really good. Probably wouldn't take too long either. Build up that range, sweep it, set the low of the week, and then continue to trend and create a buying candle. And then at the top here, we're looking at some, let's actually draw this out. You know what? Let's draw this out, quality. All right, so have like manipulation range, or I'm sorry, just a consolidation range. Manipulate it, maybe push down even a little bit further. Maybe get an SMT at the bottom, breaks up, and we start trending. Okay, cool. So we're looking to see if this comes into some sort of a, ideally a like higher time frame PDOA. Could be medium time frame as well, but it really depends on what's going on overall. But we're building up that range, right? So we're sweeping this liquidity as well into that range. Maybe we get an SMT. And this is, I'm not pair specific. This is with any pair. All right, so that can be the marker that's telling us that we are in fact done that pullback, right? And then we start to displace up. And we know that confidently this should be the low of the month. Therefore, we can just continue to trade that order flow until we hit the high of the week. And then we can start to make that pullback potentially, or just continue to range again, right? Okay, so what are we going to be reaching for? Likely some sort of a higher time frame premium discount array as well. So the monthly has targets as well, just like the daily, just like the hourly, just like the minute. The monthly also wants to seek something. Okay, it may not happen in the same month. It may or may not happen in the same month, right? We don't know, but we are definitely trending towards something, right? So similarly to over here, monthly was trending to fill this imbalance, had a reaction out, right? So starting from this month, sweep, came into the FEG, took liquidity, trends up. This month, we'll look into this month and we're going to see how this candle here developed. And just keep this in mind, all right? Keep this idea in mind of this manipulation on the sell side to form the wick and then trending into a buy side. Okay, so we're going to look into the month of June and July real quick. Right here into the daily. Okay, there's June. So the low actually happened a little bit earlier. I mean, here's the low of the month right here. But sometimes what can happen is you're pushing into that manipulation, so to speak, a few days prior, so earlier or later in the previous month, right? So we have May here that runs liquidity down into the lows. But what that does is it creates a premium or a discount, right? So in this case, a discount, which would be your type 1, your OB. There's your manipulation. 1, 2, 3, 4. Let's just refine it to this last down close candle because that's a very obvious push. All right. So there's the high. Just for the sake of simplicity, or we'll just even use the last down close candle because that's even simpler. All right. So creates a type 1, rips off. There's the start of June. June opens up, pushes back down into that type 1. Algo deems that a discounted price, rallies off, right? So there is your higher time frame discount, pushes off. We got some trending order flow for the rest of the month. There is the end of June, moving into July. So June still did not complete the target, right? And then July comes into a sell month. So this is interesting. This is where you're going to see it basically look much more like what I drew here, wherever that went. It's gone. All right. There we go. Right. So let's imagine this is inverse. Okay. So we have a range, a run into a higher time frame PD array. Some sort of a reversal, whatever that is, can be just like a big pierce up, like so. And then the swing fail. It can be an SMT. It could be your just simple run the high, break the low. Market structure shift. SMB, I failed ISP. It doesn't really matter, right? The market doesn't follow our plan. Our plan is just an edge, right? So we just have to kind of understand what the market's trying to tell us, okay? Just for bias, I mean, not to trade. So we understand how that looks. Let's go back here. June did not complete whatever it needed to do. July opens up right there. June pushes back down. We come into just that last down close candle. Let's see here. And that's a little more accurate here. I always prefer to, instead of using like the last down close candle as your like support and resistance or like supply and demand style, I'd rather look at a breaker, right? Because we trade breakers. We trade breakers and OBs, right? So if this is available, this is much easier to understand than the last down close candle because there's down close candles absolutely everywhere, right? This has actual specific criteria for it, so it's much easier to read and build a narrative around that. All right. Small imbalance in here. So it is seeking to do something of rebalance, and then there's a tiny imbalance in here. So completely rebalancing the rest of this range. ISP here, and then it rips off, right? So here's that manipulation again, right at the end of the month, not quite at the start, but right at the end. And then right at the open, big push up. So very little sell side wick on the July, if any. It was over a weekend, so that's interesting too. Opens up, rallies off. The manipulation's not needed at the open. Why? Because the manipulation that it seeks out to do is on the buy side, okay? Is everyone following along? If I'm being confusing, I'll slow it down. Drop me a Y if you're following along. We don't do ones over here. Drop me a Y or an N in the chat. please, everybody, because this is I know that some of you guys are at different points, and I don't want to confuse the shit out of you. I'll be sure to slow down.
Can we do ones?
We don't do ones. All right, cool. All right. Okay. So the manipulation doesn't need to occur at the first day, of course, right? This can occur somewhere in the first quarter of the month, or maybe even the first half of the month. Usually, I would say it's between the first, maybe the second week, somewhere around there. I'll get exact numbers on here. I'm sure it wouldn't be hard to get exact numbers on here. You could probably backtest 20 years in a month and collect that data, and in a day, I mean, and collect that data. To be honest, I mean, there's only 12 months in a year, so only 12 data points a year. But yeah, it doesn't need to happen in the first day. It doesn't need to happen in the first week, but we can see it as soon as the open price runs up, doesn't manipulate anything. It's just continuing the previous order flow, but it runs through this high, right? We have some equals here. Remember, this is a daily chart, so these are, of course, equals. Yes, it does not follow our view of what is liquidity, but those slight super nitpicky rules are more so focused on MTF and even more so on LTF. These are daily charts, right? So this is multiple trading sessions per day. You're getting 2 trading sessions per day, right? So these highs are absolutely equal highs, very significant. Price runs up. It doesn't stop here and run down. Why? Because it's seeking what it deems a premium. Okay, so premium discount raise. That is what this algorithm deems as premium pricing, right? So when it runs to something that it deems a premium price, it will then switch into what is called a sell program. Okay, we didn't really talk about too much of the concepts before the new guys joined, but I want to do that a lot moving forward. But I think because we just really want to get into trading, which is fine. When it runs up and it comes into something called that it deems a premium, it's going to switch into a sell program. Okay, and a sell program is bearish order flow, which will seek to run sell side liquidity and rebalance buy side imbalance. Okay, run sell side liquidity and rebalance buy side imbalance. Understood? That's only going to happen when the algorithm deems it is now premiumly priced and it's satisfied whatever its objective was on the buy side. Okay, so above price, right? All right, so let's go back here. This is that, just to recap here, that is just a fill of imbalance, right? So the algorithm deemed it needed to fill this imbalance, and then when it did, clearly there was a lot of sell side liquidity. So it's something switched. It switched to a sell program and it wanted to run sell side liquidity. Where did it come down to? We'll get back into the nitty gritty here in a second, but where did it come down to? What is this?
Type 1.
Into a type 1, right? So this is where we kind of differ a little bit from like pure ICT guys. I mean, I'm sure that someone that trades just ICT obviously figured this out, right? But like type 1s is a sweeping POI. It's already tapped into, but price returns back to that type 1 OB, right? So like that sweeping POI. So we understand that. There's a possibility, of course, we have one here that absolutely gets ran through. Liquidity below it. We'll understand why that got ran through. We were calling for this to get ran through for quite some time as well. And then it returns all the way down to that original manipulation that brought us higher, right? So there was that original reaccumulation. We had the accumulation down here, breaks up, rallies out of that range, puts us in a new range, builds out a new range, sweeps, reaccumulation. So anytime we put in a swing point, that'll be a reaccumulation of a trend. Grabbing new orders, continuing up, runs to the PD array. So the premium comes back down, deems this as discounted price, this is the original manipulation, right? So this is where a substantial amount of smart money orders are in, right? And you can see the magnitude of this move versus something like this, right? This is a higher time frame move. Give me a second. My monitor is really, really dark. Turn my eyes. Okay. All right, so we can see the magnitude of this manipulation versus, say, this one. Okay. Are we going to spot this and are we going to think about this in real time? We may be aware of it. However, I hope if you guys watch that bias building video, we're thinking about all of the possible scenarios that can happen, right? So, and if you guys are watching through the webinars now, you're going to see that we talked about this getting ran. However, we didn't immediately say that it's just going to turn, like it's going to run right through here and come to here, right? We're not in the business of trying to figure out exactly where it's going to end. We're in the business of figuring out areas in which it can end on the way to our ultimate target, right? So we talked about this getting ran and maybe we get a pullback, right? We talked about this getting ran. We also talked about even the possibility of this getting ran, of course, right? But we just understand the areas in which price can reverse from, okay? But looking at this back in hindsight now, we can see the difference in magnitude of this manipulation here versus this slight run on liquidity reaccumulation here, okay? The reason this is important is because now I want to take your attention to just the immediate order flow, right? I talked a little bit about structure versus order flow, right? So clearly this is like a structural leg, right? Without me getting too refined and thinking about every single candle, right? I just want to focus on the obvious narrative here, right? And if I'm not planning on taking a trade here, I'm just focusing on the general narrative of things, right? It's just to guide me, put me on the rails, trying to understand what the hell's happening in price action. There's really no rules for building price action other than common sense, right? And some deductive thinking. Okay, so you really need to, and I notice a lot of you guys, but mostly just a lot of new traders, right? And I was there too. You have this feeling that you need, especially smart money traders, or probably only smart money traders, you need to define and follow a rule set for every single thing. But the reality of trading is you only have to follow a rule set when you're trading. Your analysis is not necessarily at all. It isn't rule based, right? Your analysis, your overall market analysis is not rule based. You have concepts that you apply, of course, and you're trying to build a narrative that way based on PD arrays in the ICT case. However, it's not rule based. Rule based is you trying to push your edge. Okay, you need rules for that. You're not trying to push an edge here. We're just trying to understand what the hell happened in the market. So I obviously know that this is a structural low and this is a structural high, right? I mean, I can simplify it as well by just going to a higher time frame, of course, right? This isn't even a sweep here. So your structural leg is from, there's your SMB, and then you have one from here to here. Oops, should be a little higher. And then there's your basically your monthly leg, right? Did I really need to do that? No, I didn't. But for simplicity's sake, yeah, this is a monthly range here. All right. Going back now, I think I got a little off track there, but what happened here in this manipulation is this is part of this order flow. Okay. So this is monthly order flow, right? We're getting these up close candles. This is monthly order flow, creating this range. All right. On the daily chart now, we can see that monthly order flow in detail. So as price came from here, this manipulation had an objective up into here. It's pretty clean. And it's following our rule set all the way up into here, right? That's CO. So from this manipulation, daily order flow was following our rules all the way up into here. And I encourage you guys to go and look through it on your own time. Study the order flow, study the ISPs, see how it went about developing from here to here, how it manipulated down for reaccumulation. Okay, so looking back here, this is a reaccumulation similar to this of the higher time frame leg, right? This is a reaccumulation of that. However, this is a reaccumulation of the development of this leg, okay? That's also why we didn't get a reaction here, all right? So we have this manipulation that brings us up and creates a new monthly dealing range. We have, of every dealing range, we have 3 phases. You have the impulse phase. You hit an objective. You have the corrective phase, which brings you back into whatever it deems a discount of that leg. And then you have the continuation phase. Logically, this should run the high if we're following this trend here of higher highs and higher lows, okay? So my point being, the market didn't deem this a discount because it was not part of, or sorry, the purpose of this reaccumulation was as a development of this overall single leg, okay? So we have like a high, a lower, a higher low, a higher high, a higher low, a higher high, price pushes down. This is a reaccumulation in the development of this monthly range. Price pushes down, runs the liquidity. Then we start to trend back up, and we may or may not have something similar, right? Moving forward. This, if this goes up, it's probably going to go up significantly, but that's neither here nor there. We're not there yet. Okay, now let's go back to our original conversation about power of 3. Hopefully I didn't lose you guys there on that tangent. Back to power of 3. Does anybody want to remind us where we were with that conversation? So I know for a fact that we didn't lose you, that I didn't lose you guys. Yes.
No fucking way, man.
Where were we, man?
Lost me on the first 2 minutes. What the fuck?
Where were we?
I don't remember. I was looking at the chart.
God. Brev, you remember where we were? Otherwise, I'm going to go back.
Higher time frame structure.
I did lose you guys. All right.
I think you lost.
I was talking about. Oh, yeah, I did lose you guys. I went on a tangent. All right, so let me circle back. Originally, we were talking about power of 3. Okay, so we're talking about the monthly closes. I'm going to circle all the way back and do that again. All right. I totally lost you guys there. If I ever get on a tangent, let me know, please. There's just so much information. Sometimes I just get lost in it and then I just start talking. All right, so we were talking about power of 3 on the monthly case. So we're creating a manipulation range, run it, run up, right? So we have a manipulation that sets the lower the high of the month. And then we trend to another PD array for the to set the higher, the next higher lower of the month. So in this case, we're looking at a buy candle, right? So we create the range. This would be like that previous month's wick. So in here to here, this is this range, right? Or this range. Understood? So this would be the previous month's basically range like this. Let's color this for this. There we go. All right. You can see here. That's that range in development. And then this low of the new month is the manipulation. And then the creation of the body up into the high is from the opening price and above. So as price runs up, it's creating that body. Price hits a premium. That's right here. Sets the high of the month right here. And then it has a retracement, which is creating a new range that sets the close. And then the next month you may have something similar. Okay, so does everyone understand PO3? Everyone back on track now? Wise in the chat, please.
Yeah.
Okay, cool. So we circled back there. Alrighty. Yeah, I got on a hell of a tangent there. All right. If that happens again, please stop me. All right.
We won't.
Yeah, I know you won't.
Just let you go.
Yeah, that's what happens. Someone find Yas, he's still lost. He is. He's forever lost.
What the fuck me? Why me?
All right. Okay. So we're going to take our attention now back to that month of July. Okay. So let's go to July 1st right there. And then we're going to mark out that premium right here. And let me take your attention here. So the start of the month, this is obviously a selling month. Okay. And we can predict that this is going to be a selling month in advance by weighing out the possibility of price reaching up into something that it deems a premium or discount. All right. So it doesn't quite reach up into here. We'll talk about that in a minute, but it does rebalance this range. So if we saw that price was rebalanced in this range, I thought it was going to reach up into here, to be honest. However, just because it didn't doesn't mean it can't go bearish, of course, because it may want to come back up here after, right? So the daily reaches up into this right off the open. It starts to push up, runs up to it, big up close candle, way above this liquid region. Why did it stretch above here and not reverse right away? Because it was seeking something that it deems a premium, which was this higher time frame imbalance, right? So this is what you would call a sell side imbalance, higher time frame inefficiency, which is called the SIBI. Doesn't matter. It's an FEG. So when it runs to that sell side imbalance, that bearish FEG, it fills it, runs down, right? So we see that reaction. What we really like to see during manipulations is a big move up that just stops dead in its tracks. And this is one of the biggest signs that it is, in fact, a manipulation. This big run up stops absolutely dead in its tracks as soon as it hits. Mute. As soon as it hits higher time frame PD array, runs back down, and it's met with displacement on that sell side. Okay. This is your first possible entry. Comes up into the middle of that FEG, pushes back down, breaks the low, and now we're confirmed. We're at this point confirmed bearish. Why are we confirmed bearish, guys?
It's a failed ISP.
Yeah,
The
because
possible
we get the failed ISP.
Here's
This really,
displacement.
yeah, we get the displacement. Everything's confirming. We should have had a run up from here that continues higher. Okay, so we've hit that buy side PD arrays, that premium array. Okay, so let's go back to that idea of power of three. Previous month is in a range. All right. And let's bring this down. So, all right. So previous month creates a range. So this would be the high of the last month right here. This would be the high of June on the 16th. And then it pushes down for the second half of the month. So what would this from here to here be if I went to the monthly chart? Okay. This is the high. This is the low. And this is the open. All right. So what is this area? And yep. And what is this area? This is the close.
Wick also.
That's a wick as well, right? So this candle here looks a little bit something like this. Okay. So we have a small bottom wick right here. We have a, let's make this black. All right, cool. Actually, we'll make this white. All right, there we go. There we go. Right, so our candle looks something like this. We've had the high. The high pushes down on January 16th, creates some equals here, which we're not obviously not going to see that on the one candle. Pushes down, creates the close, and creates this bullish candle with a larger topside wick. So we have liquidity above here. Or let's just call that high of the month liquidity. Okay, cool. Now, the next month opens. Close is also, of course, the open of the next month. Right, so we're opening at the exact same price. So currently we have this, just this next candle that opens. Let's bring that right there. Okay, cool. So currently we're sitting like this. And what happens with price? It doesn't dig down lower at all. It doesn't even create a sell side wick. It just starts running up and filling this wick. So right now you have a candle that looks just like this. We have a higher time frame premium. This would be your HGF, which is your, what is it, guys? Is our higher time frame imbalance, right?
PD. Oh,
That's your premium. So it's looking to go to something that is deemed a premium, right? Which is liquidity or imbalance, breakers, type 1s, OBs, right? FEGs, okay? All of our POIs, those are what our PD arrays are, our POIs. And obviously just the discount and old highs, old lows. Okay. Price runs up above here with aggression, runs through it, following this here, runs through that high, stops dead in its tracks. So similar, we had a candle that looked like this, just a giant bullish candle with no sell side wick. And then as it pushes down, displaces down all the way back, returning before the high. And at this point, we have a big candle that looks something like this currently, right? So we're right here. Runs up, sweeps, and that creates the high of the new month, okay? If we can determine that, we would know that this is now a sell month, okay? So how can we predict it's a sell month? Well, we have a higher time frame imbalance. We now have had a reaction from it. Big reaction out. And there's possibility that this is now a sell month and it may seek liquidity at a bare minimum below the low of this month. This should be called low of the month, okay? Low of the month, okay? We ran that high again into a premium and it just switched into sells. And we can see that on the lower time frame, we're confirming that with our reactions out. And then where is July ending? Right there, okay? Right below the high. So prices run back up in an attempt to go higher. It hits this FEG. And then it returns back down lower. There's that opening price, the high. So we get the opening at the same price as the previous month's close. No sell side wick, runs up probably like a tiny wick or something like that. Runs up, hits the PD. So hits that imbalance, fills that imbalance, done what it needs to do on the buy side. Pushes back down in the creation of this candle. Closes below the high of the previous candle. Comes back up, hits the FEG right here, creates an ISP, runs back down below that candle, and we get something like this, okay? Keep that in mind. Let's go back to the monthly chart. Should look something like that. Right, there you go. Small wick on the sell side, big up close, up wick, pushes down, closes below the high of the previous candle, So it fails. What this is telling us is that it's failed now to break above, which is a good sign. And we can start to predict that that next month is going to be a sell month, just based on the fact that we've hit that higher time frame premium and we failed to close below the last month or above the last month. This is very likely that we're going to get a sell month. Okay. And then, of course, after we get a sell month, this one is extremely likely that we're going to get a sell month to follow that one based on the fact, that what's happened here, right? That's just a reversal using basically 4 candles. Okay. Using power of 3. All right. Where is my drawings? Okay. So are there any questions in regards to power of 3, how we were able to see how the candle forms just using a daily chart, right? We understand how it ran up to manipulate to set the high of the month above liquidity. So what we want to see is we're running liquidity into a premium. So into one of our POIs. Run liquidity into one of our zones. Then we get the reactions out, and then we can trade this. If we do believe that this is the high of the month, then this is a very, very, very high probability sell. Okay. You have to do this for every day. You have to do this for every month and every week. All right. You have to understand power of 3 for every day, month, and week. And if you can master this one thing, you should be on the right side of the market the majority of the time, because it's going to frame up all of your trade ideas, right? And this is more important. Like, structure will help to guide you to determine what the power of 3 is likely to be. But the power of 3 is the pinnacle of bias and direction, because if you can determine what the bias is likely to be for the rest of the month, right? If I can determine that this is the high of the month, then I would know that the weekly candles are going to be bearish. If I can determine that the weekly candles are going to be bearish, I can look and try and figure out where those highs of the weeks are going to be, right? And this is now fractal. So if we had this high of this week, that was the Friday, it pushes down. So it's the high of the next week as well. Same area, pushes down. All right, then it's a Monday over here. So that's a new week. So we had a week from here to here. New week opens. Same exact thing, where the new week pushes up. Where is the high of this new week, guys? What was the manipulation that occurred to set this new week? Okay, let me bring you back here. We have the opening part of the week right here. So it's this up close candle. And then the week closes on the last up close candle, right? So price runs here. What did we just talk about?
It's the high of the week.
Yeah, but we just talked about the same thing, where price will want to manipulate to the upside, hit something that it deems premium, which is this FEG, and then sell off for the rest of the candle's formation, right? So let's draw that one out as well. What does this one look like? Let's just there. Okay. So we're not confused. Here's your monthly formation, your monthly power of 3 here. And let's look back here. This would be your weekly one, okay? And this is super important. You can't neglect this. You need to learn how to read candlesticks and power 3. All right, so price opens up down at these lows. We'll ignore this for now. Price opens up here. It creates a small sell side wick, returns back to its opening price. So you have a small wick here. And then it runs up into FEG. That FEG is of course your premium, right? So this would be your premium, what the algorithm deems premium pricing. So it runs up, hits it, displaces down, runs straight down, right back to the opening price, has a slight pullback, and then continues to sell off. Actually, the week looks something like this, okay? Pull that up, right like that. So now we've had an area where the high of the week forms. And then every day or hour after that is bearish. So it runs that high of the week. Now we're going to go into here as well, into this one day here, this big down close candle, and look at the exact same thing. So this created the weekly candle. Runs up, comes back down, creates a weekly candle like that. Okay, we're seeing the same thing play out. Open, high, low, close. Opening price. Puts in the low, comes up, puts in the high, pushes back down, creates the close. You can see where price wants to go just based on the wicks alone. Price seek throughout the week to run that high, or sorry, to hit the premium, rallies back down closer to the closing price, right? So the objective of this entire week was simply to rebalance and then push down. Bodies are telling the story of where it wants to go in the higher time frame, which is very clearly the bodies didn't really do anything, so no new information there. However, the wicks had an objective for that week, and this is also a highlight of time and price. There is a time limit for these objectives to be completed. Okay, does this really matter for your trading? Not necessarily, but it's still very interesting to learn. Within that week, price wanted to rebalance this range and still return back to that opening price. This is the weekly candle that I'm drawing out here. And how many candles do I know to use on the daily to see the weekly candle is going to form? Generally, okay, so generally the high of the week is formed on between the Tuesday of London session and the Wednesday of New York session. In this case, it was on the Thursday, right? But most of the time it's between Tuesday's London session and New York's or Wednesday's New York session, the end of New York. That's when you're going to get the high or the low of the week to likely to form. So most of the time, this would be happening on a Tuesday or Wednesday. Of course, in this case, it happens on a Thursday. All right, so now we're going to go again. So this would be your weekly formation. And this is all happening within this monthly candle. All right, this is your... All right. So this monthly candle prints here, or sorry, this to here, to the close. And then there's the new monthly candle. That new monthly candle opens on, nope, same month. Okay, so this is the same month. And there's, let me just mark out the close. Close is right. Close is right here. Right there. All right. So we can delete that off the chart now. Go open. Open. High. Low. Close. All right. So this is the formation that we're looking at. We're looking at this single candle of the month. All right. So we're looking into this one right here that I've drawn on. All right. So number 2. In that candle, a high of the week formed. So repeating the same thing of power of 3, where there's a manipulation that looks to seek a premium and then sell off. So it's in line with the formation of this candle here, right? Sell candle. It's hit that high. This last week of the month, same thing. Hits a premium, sells off. And now we're going to look in the daily and just look at that same day that runs up there on the Thursday, okay? So there's that candle, so we can already draw that out. We have a big bearish candle. And then we have something that looks like this. All right, so you can see that. Make these black because they're all bearish. Those are bullish. All right. So price runs up off that high. And what does it do? It runs just above the previous day's high. So we have that liquidity. So we're always looking for liquidity to run into our levels. Sent it back. Okay. PDH, liquidity. It runs the previous daily high, manipulates into that same FEG here. So it's the same level, but now we're seeing this week, this manipulation that's happened in this wick that set this week's high on the daily chart, where it runs that liquidity into that and then sells off for the rest of the day, right? So now we have the monthly manipulation. You have the weekly, which is in line with the daily power three, right? Sometimes they'll overlap and be the same high and low or whatever. High of the day will be the same as the high of the week, obviously, right? The high of this day was the high of the month in this case, which was also the high of the week in this case, right? So they all overlap, right? The high of the day, the high of the month is always the high of the week on one time frame, which is always or of that week, and which is always also the high of the day of that same day that formed it, obviously, right? Okay, so now we can look into this day here and assume, if we can determine that this is the high of the day, that this will be all sells, and we only have to trade in that one direction, right? And then on the subsequent days here, like on this whole week, if we know that this is the high of the week, then we can start to sell on the following days and the following weeks. If we know that this is the high of the month and we expect that the next month is going to be a bearish candle, we can start to sell for the rest of the month until we hit something that is a discount, right? So where do we have the discounts? We have type 1, old low, and then there's like a weekly, maybe a weekly FEG or something in here, but maybe that was on not on GU, right? Then we have just these old lows, right? So we have liquidity below all of these lows. We have liquidity, liquidity, and we obviously have a type 1. We don't know which one it's going to run to, but we now have targets of where the higher time frame is going to go, and we can trade down into those regions based on the understanding that we've built from power of 3. Now, there's no hard and fast rules for this, other than you want to see like a run on liquidity into a premium. You all in a, you know, when you're expecting bearish candles, you want that manipulation on the top side. Some tips would be the weekly candle is likely, the higher low is likely to form between Tuesday's London and Wednesday's New York. And the high of the day or the low of the day sometimes forms around 7 to 9:30 a.m. EST. It can also form in London session, like maybe a sweep of Asia, and then it drops, right? So this is where we'll get into next, mostly in December or into the new year, as I update. It's more of advanced stuff, but like daily profiles and that kind of thing. Without getting in too deep and going on another tangent. Where was I? Okay, so we're going to look into this daily candle now. Okay, so is everyone following along? Wise in the chat, please. If you have questions, just cut me off because I'm not going to stop talking. Everybody, please participate. Okay, cool. Thanks. All right. Okay, so now we're going to dive into this daily candle here, and we're going to look into that trading day. All right. I don't know if I can get back that far on like a 15-minute chart, but okay, here it is on the 1 hour. So this was the previous day, was right here. So there's that previous day's high right there. PDH. And there's the, whereas this is on a Wednesday, so we're going to look for that Tuesday. There's your PDL. Your PDL is probably actually going to show up, yeah, a little bit. Well, that'd be just the previous high. The PDL is all the way down here. Where are we going here? Wednesdays. Yeah, it'd be right here. I know it says Tuesday, but on the candlestick chart, it's actually going to show there because the broker changes at a different time. About 5 or 6. You're able to get back there on a 15. Okay, so first off, let's talk about power 3 now in serious detail. Okay, so if we know that the week is looking, so we've put in a low of the week, and we're expecting the manipulation to occur up here to set the high of the week, okay? We're going to wait until it hits. When it hits, we know that we're going to get that selling pressure because now we've set the high of the day, right? So we could be down on the lower time frame. However, that's not the only thing. If you're very skilled and over time you'll develop this, you'll be able to buy up into here. Now, it's not something that I condone, right? I condone following structure at first, and then over time you kind of will step away from that a little bit. I mean, structure is still amazing, obviously, but you're going to read the actual delivery more so rather than just structure. The difference is structure is very one-dimensional, and trying to read and apply all of these different concepts in a live trading day is very, 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 very difficult, and you're gonna fail at first, right? This is you're gonna need several months of live market experience, if not years, right, to kind of get these concepts down, depending on who you are and how much time and how often you can get to the charts, right? But you could buy up this if you do believe that this is looking to come up into here to form that high of the week and then drop, okay? On that day that the high of the week is formed, let's mark that out. Of the week. On this day, right here, the Wednesday, what happens? Price runs above previous daily high, which is also equals relative equal liquidity. So it's beautiful. We have that liquidity that runs into the premium. That's able to now fill orders. Comes in once, pushes down, creates an SMB, or sorry, an ISP, runs up, taps into the 50% exactly of that range, literally exactly, or close enough by a pip, runs to the 50%, sells off SMB. We can now trade the following week, understanding that it will likely be bearish and continue to sell off, right? But let's take our attention now up into here and just look at this on a lower time frame as well. Am I able to get there? That is the question. Let's go like this. All right. Okay,
What's our middle line that's in there? Is it like the vertical line that you have in there?
No, you can actually turn on middle line.
Or sorry, not middle line for that. Like you have
these?
separating the weeks. Yeah, that guy.
Yeah, I just dropped a Alt V. If you click Alt V, you can just drop a line.
Yeah, and is that just to map out like midweek, or is that the end of the week?
This is just to that one doesn't matter. This one is just to map out the that one. I don't know why that was.
Oh, okay. So yeah, I got you.
Yeah. So this is just to map out that day that caused the manipulation. Okay, and then we're gonna go. It's Wednesdays. We're gonna go over to. Okay, it actually happened on the Thursday right here. Ah, there we go. So previous day high. Okay, so I had that slightly off. Runs down on the Thursday's open. So London session runs down 12 o'clock. And this is where we can apply that. Now we can dive even deeper into Power of 3. This is so much for a webinar, but it is what it is. This is all going to be in the course anyways. 12 o'clock open. Right there. We stretch that out to 11 a.m. Midnight open. Okay, so if we believe that it's going to be a sell day, we want to see a manipulation above an old high into a premium. So above liquidity into a premium. Reason being that this is liquidity is a previous daily high. There's also relative equals. Even though that this one pierces above the relative equals, does not matter. There's stops above, right? Majority of the stops are closer, but then as you get out, they're thinner. However, there's still a substantial amount of stops above, right? Runs above them. Takes out liquidity, pushes back down. pushes back down. Paul takes liquidity, sets the high of the week, pushes back down, comes back up. Does it tap into there? Yep, to the T. So it creates a type 1. It doesn't quite tap up. Instead, it just fills that slight imbalance, sells off, comes back up, fills some more imbalance, comes into that last down close candle, sells off again. But what happens here, what I want to take your attention to is that midnight open. So price runs down throughout London session, takes out Asian low, nope, still intact, just comes back down into here, taps in, manipulates, so it creates these equals, manipulates on a lower time frame, of course, rallies up with aggression. This is that inducement that's creating tons of stops below here. Manipulates, this is getting buyers on the wrong side. This is taking out early sellers. Runs back down. There's your first signal that we are in fact going bearish, at least on the 15. Oh, Paul, I muted you. I didn't know you were trying to talk to me.
Yeah, all good, man. Just that question.
Give me a sec. I'll get to it. So prices tap in. This is your first signal that we're going bearish. And you can see how now price is starting to respect and not make higher highs. Of course, this is substructure. Maybe on a lower time frame, we'll get a range from here to here that is tradable. I don't know if I can get down that low. Yeah, okay. So the 10-minute gives us more than enough. Creates this high, so that's your ISP high, ISP low. One FEG available. Rule 2, there's only one FEG, take it. It comes back, fills that FEG. There's your trade, cover the high, and this thing melts, right? Are you going to get that? I mean, it's very possible that you can. This is a very advanced trade to take, obviously. But this is just the power of 3. Sets the high of the day, rips off for the entirety of the day, and then it sets the low of the day right here. Low of the day. Okay. And this would be, of course, we'll just put that just slightly under it. High of the day, because it's the same thing. So the high of this day creates the high of the week, and then it pushes all the way down, creates the low of the day, and also the low of the week as well.
Well, the low of the week is gonna be on that next Friday, right? The next day. There we go.
No, you're right. That is the Friday. So there's the low of the week. The low of the week runs below the low of the day. And like I said, with our example here, in here, oftentimes the Friday, I think we were talking about it here, or this is the month, so this would be the week. The Friday will usually come up a little bit. Okay, so you're going to retrace most of that, not most, like 30% of the weekly move. Come on now. In trading view. Let's look back here. It hits Friday. So we have this weekly move. Here's the majority of that weekly move. Friday hits, manipulates the low of the day, pushes down again with aggression, right? Takes out the high, pushes down with aggression, stops dead in its tracks, pushes up, respected, runs that low slightly, and then it gets run up. And now we have your first available entry, basically right there. Last up close candle, breaker, FVG, take the one that's stacked because there's multiple that is stacked with a breaker. There's your first entry for the Friday, because we know based on power of 3 that this is likely to retrace about 30-ish% of the range. So if we look here, we have 237 pip move, 237 times 0.30, 71 pips. You can expect about a 71-ish pip move. Okay, so a little bit higher, right? 30 to 40% of that move gets retraced of this entire weekly move. See you, Chris. Yeah, guys, have a nice weekend, bro. Paul, okay. If you use the standard deviation, would it be that bearish pin bar at the top of the high of the week, or would it be where the SMB is? So this is how it works. That's actually a really good question because it ties right into this. How can we figure out where the low of the week is likely to form? So first off, below liquidity, of course, we know that this is a weak level based on the trend. High, low, lower high, lower low. However, we can also measure the manipulation. So the manipulation is from the low, so the start of the run up that's taking everybody out before the breakdown. So we're looking at this region right here. Where does it run to? 4. So we're mostly looking at 2 and 2.5. I have a 3 on the chart. I don't think most people do. But you're mostly looking at 2, 2.5, and 4. I like the 3 because sometimes it runs past, right? If this is paired on with something, I'm taking it. But look at the accuracy of how it extended this leg to set the low of the week. That's just ridiculous, bro. Like it's actually ridiculous. You can't make it up. Sets the high of the week, runs down, and this is on the Thursday, meaning that there's not very much time to hit the objective that it wants. It needs to do it before the end of Friday. So it does it all within one day, creates a range. So this is the next power of 3. This is very interesting as well. So the end of Thursday creates a range, right? So this is that wick of Thursday. This is that sell side wick of Thursday. Let's try and draw this out. All right, so there's your Thursday. So Thursday runs up, creates that manipulation. This is your opening price. So it runs up, creates that manipulation, runs down, creates the low. And then in here, in that low wick, it's going like this. And that's creating a range. All right. The next day opens, runs down, takes out previous daily low. That'd be your PDL, previous daily lows liquidity, where this range gets manipulated. Runs up, pushes back down, fails to run low again. It also hits the standard deviation, which is really nice. And then it runs and creates a buy day in the opposite direction. Just that same power of 3, right? So accumulation happens here. Manipulation at the start of the day. Distribution as the candle's forming like this, runs up, creates the high of the day. Probably something like in the middle of that candle. And then it starts to range again. So it's creating out that new range. So it's yeah, it's pretty amazing stuff to see. Just solely about power of 3. It's such an in-depth topic, which I didn't talk nearly enough about in the course, but in the original course. Any questions, guys? Any input or any questions? I know this is a very, very advanced one, but I just kind of want to talk about it because I feel like I didn't talk about it enough in the previous course, and it's going to be in the new course. So you guys are going to have a lot to dig through.
Yeah, I mean, just as like, I guess an exercise, like we can just go through price and kind of
absolutely. You don't have
go
to,
through
you don't, yeah, no, 100%. You guys don't need me to tell you to do that. Like this type of stuff you need to do. You need to understand power of 3. It's crucial.
Yeah, so it would basically just be like us, like when I go and do like practice this, it would basically just be like exactly what you did here, right?
Absolutely. Yeah. Build up case studies, right? Build up very, very advanced case studies like this, where you're understanding fractally. I would start maybe with, actually, you know what? I'm not even going to say that. Go all in, right? Just try and figure out everything fractally. That's the best way to do it. It's just to dive in and not kind of limit yourself.
Yeah, it's a bit better. Like the other case studies I did for power of 3 are basically like I mean, they're pretty vague. Like you could look at this and be like, all right, well, that's a range, like it's accumulation, manipulates here, distributes, but it doesn't, like the case studies I've done don't like dive deep into like what's actually causing it. It's more of like a mechanical way, like you can just see it, but actually understanding it is totally different.
It's very, very difficult to explain, man. I got a lot of ums and ahs in this video, but you need to build out a narrative. Okay, so power of 3 is your bias. Okay, and bias is always backed by narrative. Okay, narrative is simply understanding the story of, the algo. So what is this algorithm? What is this smart money trying to do? Both the algorithm and the smart money. The algorithm's job is to create an efficient marketplace for smart money. Okay, So what is the job of these two parties in the marketplace? What is their goal, right? What is their objective? Then your next question is, how did they go about achieving this objective, right? So if their objective is to come to an area where they deem premium price to fill orders, how did they go about filling those orders? Relative equals, manipulated above previous daily highs liquidity, taking out all of these sellers, right? This also introduces buyers into it, which creates liquidity below here. These buyers are all being sold into. So everybody that's buying up this, right? Everyone that's buying in this leg, trying to chase price higher, is being sold into, right? So it's not just one order here that's being sold into. There are sellers. There are smart money selling above here. Smart money selling above here. Smart money selling in this leg as buyers are getting involved, right? So it's an accumulation of orders over a longer period of time. When you have like billions and billions of dollars, you can't just place one order, right? These are a ton of smaller orders that are broken up into many, many, many pieces, right? Otherwise, you know, if you could place one order, there'd be hedge funds that are doing fucking 1,000% a year, right? Just trading. But when you have that kind of money, you don't, right? You go crazy if you make 10%, you know, as a hedge fund trading billions of dollars, because you're not able to fill your orders anyways, right? There's only so much money to go around. When you're trading with massive amounts of money, you're taking out massive amounts of that daily volume. Okay. So again, without getting into too much of a spiel, build the narrative, right? Build the narrative through smart money. And this is something that never stuck with, that never like sat right with me when, you know, we were all kind of learning from previous programs, is they don't talk anything about actual smart money. They don't talk anything about anything. It's just how to draw. Yeah, it's just how to draw a box on a chart, right? Which is fucking ridiculous, but it is what it is. How do I draw a box on a chart? Oh, if you draw a box, you'll make $1 million without any understanding of what's actually happening on the market, and without even any discussion about risk management either. It's just ridiculous. Anyways, build out that narrative. Really try and understand what the hell is happening with smart money and how these guys are. First off, how is the algorithm creating an efficient marketplace for smart money? How is it going about creating this delivery to facilitate the orders and trap dumb money, right? Because that's what it's doing. This algorithm's job is to create a efficient marketplace, not for me and you, but for large institutions, okay? Countries, banks, investment banks, central banks, right? Not for the retail investor. The retail investor is unfortunately used as liquidity for these guys, because that's just, it sounds evil, but it just is what it is, right? It couldn't operate any other way. So we have to start to think about the market through that lens as well. You know, what is this algorithm doing? How is it trapping the retail investor in the market? Build that narrative, understand why did it come up to here and why didn't it reverse from here? Why was this delivery so corrective and then this delivery so impulsive? And this will be in the new course as well. This is a market maker buy model, where we have this original consolidation. This is an accumulation of orders on both sides. This stops above here, stops below here. Smart money is buying here. And then algorithm starts to reprice. This is all liquidity. All of these lows here are liquidity that are designed to be ran later on. Price runs up, fulfills the orders of the large money, and it runs down. And that large money is, first off, buying at these levels as they exit their positions. They're buying over here, especially. Like, this is the main goal of this whole move. These lows are used to fuel this move lower to run to these stops. All right. Everyone following along? Any other questions? Here you got ones, a Ys in the chats. Please and thank you. Why is in the chat? Why is in the chats? Sabs, you following? I remember we talked a little bit about things. You drop a Y in the chat if you're following, or an N in the chat if you're not. We lost your boys.
What does it look like, Cash? From because don't like big institutions as well? Like, aren't they happy to take like a loss on certain positions to go after more liquidity to fuel the bigger move? What like I know it's quite wishy washy, but I don't really understand it. But like how does it look like? So surely these surely these big funds aren't always winning, right? Surely they take losses as well.
No, okay, but here's the thing. Okay, so it's incorrect in that idea, at least as far as I've learned. So
Yeah.
in supply and demand, guys would think that, oh, these guys are underwater that bought here to create this manipulation, because they don't understand that there's actually an algorithm that's also doing this from central banks that need to facilitate orders of it certain times a day. With, I don't want to get too much into it. I will get into it in the future, just not in this video. Okay, but there are certain settlement dates, times and dates that need to happen, right? So that's why that time and price works. Okay, and this is through central banks. They have certain specific hours of the day and certain days of the week that they need to settle certain orders, right? And it's done all at once. That's why you get big influxes of moves at certain times in Forex. Okay, so this price move is not a buying action of institutions that are manipulating to get themselves underwater so that they can sell. That doesn't make sense, right? The reason that doesn't make sense is because they're not actually underwater. If they have bought here, but they sold here, the profits from selling here far outweigh the hedge in the opposite direction. So they're just in profit. They're not underwater at all, right? However, this is what they don't talk about in supply and demand. So they're like, oh, because they're underwater, they need to mitigate out of these. But that doesn't make any sense at all. They're hedging positions, right? So if they have a certain amount of capital in USD or sorry, in GBP, for example, because they bought here, they ended up selling that GBP back for USD up here anyway. So that position's already closed, right? However, what they don't talk about is that there's many institutions playing against each other, right?
Yeah.
Which they don't mention. So there's definitely people that are underwater here, but they're not intentionally underwater. They just got caught on the wrong side, right? Now, whether they're going to mitigate out of those positions, maybe not. But what they're going to do anyways, these are hedge funds. So what hedge funds do is they hedge positions. So they may be underwater here. And what they could have done is they could have sold maybe here. So this buy is still open. This buy is in a loss. And then they enter a sell, right? So that sell now is canceling out this loss. So when this sell, okay, this is about hedging. This is going to be a little advanced, and retail traders do this too if you're into hedging. But there's a loss here of this amount, so they're in this much drawdown, right? So what they'll do is they'll enter a position in the opposite direction, and they're not break even. Let's say they entered here. They're not break even until prices hit here. So when prices hit here, they're now mitigated out of this loss. So there's no such thing that price needs to come back up to here to mitigate out of the position at break even is nonsense. They don't understand what hedging is, right? They've now hedged the position because they have a long, so they bought GBP, right? And then over here at the next liquid region, they've now sold it, or they've bought USD. So now they have a buying order of GBP that's underwater by 68 pips, and now they have an order of where they bought USD, which is now, well, currently is only up 34 pips. So they've mitigated the loss of half of this order already. And then when price runs down below that region, now this whole trade idea, this whole hedge is now in profit. As price runs below this low, this is pure profit. So this order's still open. They can close this whenever they want, right? But this is how hedging works. This is how hedge funds trade, because they're constantly rebalancing the portfolio across different assets. So in this case, they're trading against two assets. They're still hedging, right? So instead of having like a stop loss, for example, because they're not able to just get out of orders that fast, right? So they can't just set a stop loss here. I mean, clearly some of them did, and that's why you're getting this big spool of price action, as well as the algorithm just repricing simply. But below here, they've now hedged in the opposite direction. So this order is still open. And then now they're in profit when the profits of this second trade mitigates the losses of the first trade. All right. That's what mitigation is. Mitigation just means basically the canceling of an effect, basically, of something else, right? Or like the dampering. Like, what is the exact definition of mitigation? It's not to return back to a supply and demand zone and fucking cancel an order, that's for sure. You know what I'm saying?
It's to protect yourself against any potential risk, isn't it? Mitigation, really.
Yeah, it's an action reducing the severity or seriousness or painfulness of something, right? Well, there you go. So it's to reduce the effect of the pain of this. So how do they mitigate out of that? How do they mitigate the damage of this loss? Is to hedge in the opposite direction. And now when that stop, the same amount of loss from that stop is regained by the same amount of profit in this case, assuming that these positions are the exact same size, of course. That is the mitigation of that risk.
Then what would they do then? Would they just sell out of all the GBP and then hold the USD?
It depends, right? It depends, like things like leverage, right? If they're using a large amount of leverage, then they probably will, because they're going to be paying the overnight fees and all that, right? They've got to pay swaps and that. If they're not, if they're using like a cash account with billions and billions of dollars, then they may just hold the GPP, right? Because they also have their swing positions as well. They don't just have their trading desks, but they have large positions that they're holding for months. So they may see this and say, hey, you know what? We're underwater on this position, but this one is now mitigated based on this position. So everything down lower is pure profit, and we can keep this one open, right? So then when they close out this trade in profit, anytime that price returns back to this one, this loss, this whole loss down, is now being recouped as pure profit because this one paid for it. Does that make sense?
Yep.
So they can have an idea that, okay, yes, we're underwater on this position. However, somewhere in the next 6 months, we expect prices are going to be higher than this. So it doesn't make sense for us to close this position, just assuming that they're on a cash account.
Well, they haven't realized that loss, have they, as well? So
yeah, they haven't realized that loss. So exactly. So as long as they're not on super high leverage and they're paying useless fees, there's really no sense for them to close out the position.
Interesting, man.
Yeah, that's what actual mitigation is. Not fucking, it needs to come back to a supply and demand zone to take out of their own law. Like, what? Bro, it never made any sense to me at all. It never made any fucking sense, man. It's crazy. Yeah, it made no sense to me. Any questions, guys, about Power of 3 or actually anything at all?
All good for me.
Alrighty. That was an in-depth one.
Yeah, it was good, man. That was good.
Yeah. That's fucking, blows my mind. The projection absolutely blows my mind. Every time I see it. All right. And if no more questions, then we'll leave it there.
Nice. Seriously. Thank you for the session.
Alrighty. How did everybody, hold on before we end. How did everybody like that Power of 3 example? Like, was that too confusing? Was it too quick? I know, again, that it's going to be in the course, so it doesn't really matter, but for my own teaching style.
It was good.
No, it was good.
Alrighty. Everyone's clear on it?
Yep.
Okay.
That's been recorded, Gio.
Yeah, absolutely. I'll upload it right away. This one, I know I haven't been uploading the previous ones, but yeah, my head's kind of been elsewhere. Trying to focus on the course and not, but this one was good. Alrighty. Next time, if I go on a fucking rant, please cut me off. I know you won't, but please do it. Okay, we'll leave it at that.
Thanks for everything.
Later, guys.
Thank you.